All right, welcome back, everybody. It's another week, another Ask Me Anything happy hour. We are here to answer the questions. We've got everybody from the team starting to roll in. Well, not everybody, but close enough. So we're going to be ready to rock and roll.
All right, Navigate Your Ventures is saying, are you able to adjust the annual premium halfway through the premium year with One America or only at my anniversary date? Currently on monthly and checking because the policies all seem to have their own unique guidelines.
Yeah, you can adjust that premium mode at any point really throughout the year. But in your case, if you're on monthly, you want to switch to annual. If I remember correctly, you will need to pay up all the months up to that the policy anniversary date before it'll switch to annual. So it's like you're paying up the rest of your year.
Yes, and they have to run the calculation too, right, Linus? Because sometimes you can't maybe get all of it in right at that exact time because you structured it to do monthly. But Navigate Your Ventures, the wealthy have more choices, as we like to say. So yes, you can do that. You can do that. You just have to get it figured out for you.
It's also a nice way to get more money into a policy if you aren't going to be starting a second one, but just want to get, you have like 5,000 that comes in, you can pay up your policy for the rest of the year.
Okay. Kurt Sprigler, 38 Realtor, saying, hey, Chris, thanks for the time. I have a question. I have a policy with TMM and I'm in my first year. Should I pay down my interest and loans directly to the policy or keep the cash in my own account?
Yeah, great question. So
I know someone has a spreadsheet for this. Good, Chris.
Yeah, we got a spreadsheet for this. Now I'll give you how I do it. I always take the money from wherever it's making or the recapture, and I always flow it back into the policy as a loan repayment. I keep the circle moving. Now I know Brent teaches it where the money stops at the segregated account and waits for an opportunity there. But you know what? If I can pick up a penny or a nickel here and there by saving interest that the insurance company charges, I'm going to do it. So I'm always going to tell everybody, complete the circle. Fill out the loan repayment form. The I-team can help you do that. We can help you do that. Get that money back into the policy as a loan repayment. And then when you find a place for it to be repositioned, then you can take the loan out again. I mean, screw the insurance companies and the playing financial gymnastics with them. They can handle it. They got teams for that. So do yourself a favor and complete the circle.
I love that. I started a group. It's a recovering circles group because I see all the videos of Chris just waving his arms around, going in circles, and Mr. Helock. I have nightmares some nights. I just wake up. I know it's the right thing to do, but man.
I like what Tess is saying down there. Grab the coins while heading to the dollars.
That's the way to do it. That's the right way to say it.
I like
Absolutely.
That. I picked up a penny yesterday because it was on heads, and the other one wasn't, so I only picked up one of them. Anybody else do that?
Yeah.
It's tax-free. It's great. Now, they're probably going to want you to declare all those pennies you find on the street, but I don't.
Okay, so Christian O'Mara is saying, is commercial lending in IBC the same as buying a car, just higher interest?
I'm not sure I understand that question.
I certainly don't. Christian,
I kind of get it. I kind of get a gist of it. Like, you know how you do the car example? What's the same or different when it's not a car and it's real estate?
Oh, I mean, when it's real estate, depending on whether it's you buying real estate, I just always match what the banks are charging. I mean, that's how I do it. So if I'm buying a car, what is the best interest rate out there for banks? You know, for the last couple of car deals I did, it was Ally Bank. So I just matched what they were charging and I pay myself back the same. So for commercial lending, like if I was paying off a mortgage for one of my rentals, which I've done, I just pay off the exact same amount that I was paying to the bank that held the mortgage. Or if it's a brand new deal, just same thing. Go online and find out what are the local community banks or credit unions charging on commercial loans.
Looks like he's talking about the heavy equipment, which on page 50, is it 51 or 52 in Nelson Nash's book? There's a perfect example of equipment financing.
Let's see if you passed. Let's see.
52. I'm going to go page 51.
Lamp.
Did I get it?
51. Part 4. Part 4. Equipment financing.
Look at that.
That is impressive. What a memory. It's repetition, folks.
Mr. Brent Jr. over there.
Yeah, but no, Christian, that's a really good example because it does talk about how to capitalize a policy and then run the money back into the policy and all the excess that you would pay in that loan. So you're going to pay the policy loan off, and then all that excess goes into the premium side of your policy. And Nelson's example is a really good, it just kind of shows how the money flows. Now, we've done a couple updates to that equipment financing model. It's been on the Wealth webinar and some other places, but the concept is the same.
Only limited by what, Craig?
Imagination.
Well,
I'm going to double down for Craig.
Yeah, and one of the things that Nelson talks about is you don't want to have too much financing with too little capital. So he starts talking about how he finances one truck and then he finances 2 trucks and 3 trucks. And there's only so much financing a certain policy will do. So we want to make sure that you have the capacity in your policy to accommodate all the financing, the equipment that you want to finance with your policy or policies.
Okay.
All right.
Want to give a shout out to Living the Life. Said, hi guys, minutes ago I was notified that 2 policies for grandkids are in force. Total of 3 policies with One America. Thank you.
Awesome.
And then Lynn Green is saying, I was just going in periodically and putting money back in loans. Is that the wrong way?
No, you can totally do that, Lynn. Like that's the beauty. Like, remember Craig just mentioned, or I mean, Chris just mentioned, it's just a exercise in imagination. You're the bank. You set the terms. How I do it doesn't have to be the same as how you do it, because I do the same thing, Lynn. I mean, when I loan money from my policy, the money goes out and works, and whatever it makes is exactly how much I put back into the policy. Now, all that money cannot always fit, but I just keep it moving. So there's always new loans going out and new recaptures coming in. So I do the same thing. If I ever have just like a chunk of money sitting around, in the bank, and I have these outstanding loans, I take chunks and I pay them down on the loans as well, because why would I pay the insurance company 5 or 5.2% when I've just got the money sitting in the bank earning nothing? Because my bank pays me 0 interest for keeping money there. So I try to keep no money there. So any way you want to do it, you can do it. So you're periodically putting money back into the loan, perfectly fine. I just like more regimented ways of doing it, and I like automation, because I've got so many loans out there that I could never remember to make periodic payments on all the loans. So I just continuously keep automations going and automatic loan repayments set. And when I get extra, I just dump it on it. So do it whatever way works for your system.
I do the same thing, Chris. I have like 400 and something that I pay every month, and then only once this year was I able to like dump a big amount in. But
I just think it's good to teach people to build habits, right? Like, the more automated you can make your financial life, the better off things are. People have so many things happen in their lives. They get busy with so many things that if it's always relying on the I'm going to use that word imagination, but on your memory, you're going to eventually drop the ball, and things will happen, and then all of a sudden it won't get repaid. So like you said, Sean, I just like setting it up. And every time I buy a car, I increase my loan repayment. Every time I loan money out, like I'm doing 2 loans right now. Once those loans are finalized, I will go in and I'll adjust the loan repayment. I just keep increasing it. That's almost like my badge of honor, my trophy, if you will, is every single time when money goes out, I increase the loan repayment, which sounds crazy because, like, can you imagine if you went to somebody, at your local church group or your just your local hangout, wherever you go, and you said to them, oh my God, I am so excited. I just increased my loan payments by $2,000. I'm freaking pumped. Everybody in there would look at themselves being like, maybe this person shouldn't be here anymore. They would think you're crazy. But then you'd have to explain to them, oh, the loan repayments are all going back to my private bank. I keep all that money. Yeah, that's mine. So that is good.
I actually, every time that you talk about this, I love it because it anchors it back into my nervous system and hopefully everyone else's as well. Because it's like, there's a saying, I think it was Bruce Lee saying that, said, I don't fear the man who's practiced, 10,000 kicks, 10,000 different kicks one time. I fear the man who's practiced one kick 10,000 times. Mm-hmm. And you're doing it over and over and over again. And it really builds up that skill set. So,
and I don't know if it's like this for the other companies, but I have Mass Mutual, and like, it is bittersweet that when you take out a loan, like, there is no bill coming in the mail that's going to tell you, hey, pay this much towards this month. Like, it doesn't happen. Like, so you have to set that discipline for yourself, and it's easier to set it. The only statement that's going to come in the mail from, at least, like I said, I only have Mass Mutual policies, is that one at the end of the year that tells me how much interest. But otherwise, it's not saying like, hey, you have this balance and you should throw money in there. So it could easily get out of hand if you don't just set those things up.
Yeah, and I just want to comment on, so Eve mentioned in one of the comments about paying off your loans. If your money's out working and you've got it out in a private lending deal and it's making more money, then you don't necessarily want it all going home. But at that point, if you've got the gains coming from that private lending, those might go back into the loan, or you might be putting those back out into another investment. So in those cases, we would say just cover the loan interest at a minimum, right? So that's one path. But let's say that you've now taken a loan to buy a car. That's where what we're talking about, just restructure the payment every month, just like you're going to pay a car payment to the bank, pay that back to to your system. So I think a lot of these, should I pay my loans? When should I pay my loans? How should I pay my loans? It's going to be situational based on, are you private lending? Are you financing equipment with it? Are you buying a car? So there's a lot of shenanigans going on here. So hopefully you caught that.
Yeah. He's almost bright red, Steven. Do it one more time. One more time.
Welcome, Joe. Welcome, Joe. What's up, Joe?
I was on a call. Sorry, I'm late.
It's okay.
We love you. Welcome to the show, HELOC Joe.
It was probably his one call of the day. It started at 8 a.m. He just got off.
Wow.
Wow, is right.
All right. So Alyssa M is saying, hi, I need to ask this basic question. Thank you for your help. So in the car example, how can one take out $25,000 in the third year when the cash value looks less, only 12.2 in the second year?
So this is a common question that comes up because
Really?
yeah, a lot of people look at, where did that 25 come from, because the cash value doesn't have 25 in it anymore. But that cash value number that you're seeing is after you've taken the 25 out. That's what's remaining.
Oh, the 4,200 and change or whatever that works
Yeah,
out.
it's more
You
now.
got like 29,204. You take 25 out, and there's like, yeah.
No, this isn't, I think, in the car buying example, when
Yeah, it's
you're putting in 10,000 a year and then eventually you take out 25 to buy the car.
Yeah.
A lot of people look at the cash value remaining thinking that's what you had to take a loan as, but you've already taken the 25,000 out to buy the car.
Exactly. And it's designed that way to show that, because I want people, when I'm presenting that, I want people to think that there's only the $4,200 and change. I can't remember what the exact number is on the thing.
4204. Yeah.
Thank you. I thought it was 42. Yeah. So 4204. I want people to think that's all that's in there, because that's what most people would think. If you saved up 29,000, took 25 out, you'd have 4,204 left, right? So that's how a bank works, but that's not how a policy works. You still have 29,204 in the account, even though you took 25 out and bought the car, because the 25 you took out was money coming away from, or the money that you're borrowing against, essentially. So your 29,000, you're borrowing against that. The insurance company is lending you money from their general account, collateralizing it with your $29,000, and then they're just subtracting it from your death benefit, making it so that loan technically doesn't need to be repaid because they've already accounted for it being repaid the day you die.
Great question, though. No one's ever asked me that question. So
Surprised people get hung up on that, but I guess I can see where that would happen.
I like how Craig knew exactly what
He did too, man. That was
what
good.
they were talking about, because I knew that nobody else would.
I just presented it like 40 minutes ago, so I still remembered for 40 minutes.
Kurt is my new favorite guy. Smartest guy on here today.
All right. So Kurt is saying, I recently sold a lot of crypto for a lot of money. Should I pay off debt, pump cash into policy, or buy more crypto? And then all the above. Okay. We'll start there, and then I got another question. Go ahead.
Well, what my thought would be is, if you take that cash and pump it into your policy on the premium side so that it's going to compound and grow for the rest of your life, then you take that, pay off debt.
Yeah.
Once that debt's paid off, take the same debt payments, run that back into your policy to pay that loan off.
Or
That'd be the way I would do it. And me and Steven and Andrew just did that on Wealth Webinar today, where we actually showed the math on the policy, and we showed like how beneficial it is to put the money into the policy first over the long run. Now, it's not super beneficial in the short run, but in the long run, it's a massive benefit. Buy more crypto? No, just wait for crypto to go down. Remember, buy low, sell high. Don't buy high, sell low.
And then a follow-up question from Kurt saying, can I move that crypto sale into my trust, beneficial or the business trust?
You
Why?
could. Why?
Yeah, why?
Who else just said that?
I did.
Yeah, you could, but why would you do that? I mean, only for asset protection or to get the money out of your out of your probatable estate. But in that case, you would use like a living trust, and that way it's not, I don't know how much money we're talking, but moving it into like a irrevocable trust would only be in the case that you have an estate tax problem or an asset protection problem. But just remember, once it goes into an irrevocable, it can't really come back out or can't really benefit you. It can, but it can't. There's a lot of things with that. I wouldn't move it into a trust.
As we're finding that out.
Yeah.
That only took how many 9-hour drives have we taken with me trying to explain this to you, Joe? 6 now? It's just starting to sink in, but that we have a pattern like that. It's only going to take 18 months, and it should finally land 16 months, and we should finally be there. So that's going to be a lot more drives, Joe.
It's okay. We'll make it work.
Yeah, but is Joe sleeping during those drives when you're talking to him, Chris?
Not the last trip. I mean, he got tired for a little bit, but I made him stop for Starbucks. And that fucked his ass right up.
All right. A follow-up from Alyssa was, in the policy, do we not only get a percentage, so 65% of 10,000 every year as cash value?
Well,
not 65% of 10,000 every year. Maybe the first year.
It grows every
year. It grows.
Yeah, you got to keep in mind the cash value is growing multiple ways, not just on the.
Can anyone just share an illustration and show it? Like, we always talk about it, but like this is like the third question today that's very similar. Can we just show an illustration?
As I explain it, I say in year 1 you put in $1, you have access to approximately 75 cents. In year 2, then you have access to 85 cents. And then in year 3, it's like 95 cents. And then in year 4, it's like $1.05, $1.10. That's how it increases. And then as the policy becomes efficient, that number, that's when we put in that $1 and we can take out that $1 or more. That's called the efficiency period. So usually between years 3 and 5, that happens. Sometimes in year 2, sometimes in year 6, depending on age, depending on how the policy is designed. But then back in 7, 8, and 9, that money that you didn't have access to in the first 1 through 3 years is now going to come back to you. So by year 10, the amount of money that you put in, you're able to take out more than what you put in, 99% of the time. And then in year 11, that $1 will be about 200 to 300 times.
What's the force behind that? Why is that happening? Why does it?
The 8th wonder of the world.
Niagara Falls?
Compounding interest.
Niagara Falls is the 8th wonder of the world. But anyway, so, and I might butcher this, but Bodhisattva, I think I got that right, says, can a felony stop me from getting the correct licenses for lending? It's actually a good question, because I bet you a lot of people think with the private lending stuff that goes on in Private Money Club that they need to get a license. Now, hopefully you're still on Instagram listening. Typically, if you're doing private lending, it's state by state, so check with your state or an attorney in your state. There are a number, like you can do a certain number of private lending deals without any license. Unless Colorado. If you live in the shitty state of Colorado, oh, sorry, Greg. If you live in that beautiful state called Colorado, you cannot lend at all, no matter what. But if you don't live in that beautiful,
I don't
really.
Yeah.
I wish I knew why though, because it feels like the Mandela.
They want you to be a mortgage broker.
Like,
they want you to get a license to be a mortggage broker. That's all. So you can't even do one deal in Colorado without a license. But in most states, like New York, I think we can do like 5 or 10 without a license. And the other way too, like let's say you did 5 loans personally, and then you had one entity that you did like 5. Let's say your limit was 5. You do 5 personally, then you do 5 from an entity, 5 from another entity. Now, don't hold that as the gospel is like that's going to get you around, but like it's so easy to kind of do that. You know, when you start doing 20, 30, 40 loans, yeah, you're going to need to get a license. And yes, a felony could stop you from getting that license. But the question I think you should be asking is, how many loans can I do before I need a license in the state that I'm domiciled in, or your entity is domiciled in?
Rain Check is saying, do I need to have a policy with you guys if I want to join PMC, the Private Money Club?
I'd like to get a rain check for that. No, you do not. You definitely do not have to have a policy to be part of Private Money Club, or you don't need to be part of Private Money Club to get a policy. It's either or.
Eve's got a great answer too,
Hold on.
though.
Oh, where was it? Oh, okay. Eve says, no, you don't need a policy to join PMC, but you will kick yourself later if you don't start soon.
Yeah,
Yeah.
that was the optimal answer. That was a
Yeah,
better
that was good. Rain check, please.
All right. And then Rochelle is saying, how much do we need to start a trust account to do infinite banking?
You don't need a
Let's ask
trust account
another
to do
question.
infinite banking.
You-
This trust
Sure.
thing has gotten way out of control. Joe, like people think they need a trust for everything these days. And you know what the problem is here? It's all these companies out there selling and pushing. I'm not going to name them, but we all know the one that, anyway, pushing these
Everybody
trusts.
wants your money.
Yeah, they're all trying to sell you a trust and tell you need a trust for this, for that. Most people, I'll be clear, most people do not need a trust ever.
No.
Okay. Maybe to open it up to the majority, a living trust, like a revocable living trust. So your assets are outside of your probatable estate. Outside of that, the majority of everyone we talk to does not have a need for a trust, but yet they're sold like they're freaking Skittles.
Yeah.
Well, that's what I
Just
was going to say. I feel like the way Brent Carlson talks about like how a will is not enough. I do feel like one of like a trust, maybe
But that's a living trust.
A living trust.
That's a revocable
Yeah.
living trust. So here's the easiest explanation. This is what people need. In the trust world, the biggest thing that they would need is a voice from the grave, a set of instructions that they do while they're living that still carry out when they're in the grave. Now, a will is not enough. I'll be the first. The will determine where your assets go, but a will typically is one of the, I just don't think they're really going to hold up too much. So the trust, you could have everything willed to the trust or just have things moved in the trust while you're living. And then you have a set of instructions for your beneficiary. So if you don't want your children to inherit everything that you've built because you're worried that they're going to go blow it, or let's say, in my family, my one cousin was like severely addicted to drugs, stole from everyone in my family, not trying to air dirty laundry, but let's say my aunt, were to pass away. And let's say she didn't have a trust or didn't have a set of instructions. He would get that money. It would just go to him and probate would give it to him if it was a probatable asset. What do you think he would have done? Now he's in rehab right now, but what do you think he would have done with all of that money? He would have went and bought drugs and did more drugs and maybe died because he had the abundance of drugs. Like think about that. That's not what any parent wants. So the trust gives you that set of instructions. So when you're gone, there is a set of rules for how your beneficiaries get that money. Very important. And also it gets it out of your probatable estate.
Yeah. The other thing too, a lot of people talk about is it privatizes your estate too.
Correct.
And that's a big deal for some people that have assets that other people might try to attack and come after. And additionally, this is kind of one of those stories, but I had a client, I think it was their father passed away, very elderly. All of a sudden, their mother was getting phone calls late at night from people trying to convince them to do something they shouldn't be doing. Is because their information was on the court system and they knew it. And so they're calling them and trying to get their money. So kind of horror stories like that. But yeah, the trust can avoid that.
Okay, and then Rochelle is saying, I was paying $500 a month for an IUL, but could not take a loan off of it for a year or more, but then not off the death benefit, just the cash value. And then to that point, though, the loan's not going to be taken off the death benefit for a whole life policy either. But continue.
Yeah, I mean, I don't want to beat a dead horse because I mean, we literally there's not much left of the horse. We beat it. We beat it so much it might as well just be talcum powder at this point.
Be glue at this point.
Yeah, it's glue. It's like I can't beat the horse anymore. Like IULs do not work for the infinite banking concept. I'll say it again. IULs do not work for the infinite banking concept. If you're putting $500 a month into an IUL with the hopes of being able to take out the maximum amount of cash value to pay off debt, buy cars, invest, do whatever, you've got the wrong machine for the job. It'd be like going outside with a big nail and you got a screwdriver in your hand. Great tool. Screwdriver is perfect for what you need it for. Try pounding a big nail in with a screwdriver. You just got the wrong tool. Like get a screw and the screwdriver is the right tool, but you just got to match the tool with the goal. And IULs, shit, I don't even know what tool that's for, but
my analogy is playing baseball with a soccer ball.
Now I got a good one. You ever gone into a store and there's a widget that you're going to buy, but you can't make any 2 cents of what the hell you'd ever use it for, but you buy it anyway, just because like somebody said, oh, you should buy this thing. And you're like, I have no idea what I'll ever use that for, but you just buy it and it just sits on the shelf. That's an IUL. You overpaid for it too, but that salesperson got a nice commission. So
I do want to hit though that, you know, she couldn't take a loan for a year and then just not off the death benefit, just the cash value. So I do want to just hit again that part is the same with us too. You're taking a loan from your cash value, like correlated to your cash value, not necessarily from the death benefit with.
Oh, I see what you're saying. Yeah. So a lot of people do, and I can see where that could be confusing if somebody just kind of watched Instagrams, you know, and didn't get the whole story. But a lot of people think, hey, I got a $500,000 death benefit. I should be able to take a loan for the death benefit. You can't, you're taking a loan from the general account of the insurance company. They're subtracting it from your death benefit, but you can never take more than your cash value because the insurance company wants collateral. It'd be like going to a bank and saying, hey, my house is worth $500,000. I have $100,000 in equity, but give me a $500,000 line of credit. The bank would say, no, we'll give you a $100,000 line of credit or a percentage of the 100,000 because that's the amount of equity you have. No, I want 500,000. That's what my house is worth. Doesn't matter. They want collateral.
I actually say that they're giving you a loan based on your deposit, because if you don't deposit it, you won't have cash value. So the general fund is giving you a loan based on what your deposit is, because it's not a magic bucket. You can't just put $1,000 in and take out 500,000.
What?
Yeah, I know. I wish
it was. We all wish it was.
I'm leaving. I'm leaving. Are you saying banking is boring? Is that what you're saying?
I'm going to refrain from saying it the way I do.
Yes.
But
yes.
Or Joe, you got me thinking. It's almost like you're the home, and like it's like you're paying your policy. It's like the home equity.
So I explain to people. I say when you put money into your policy, you keep on depositing money into the policy. The general fund of the insurance company lends you based on your deposit, and if there's a loan on the policy, they minus it from the death benefit. Nothing happens to the death benefit or anything while you're still breathing. If there's a loan, then it gets minus from the death benefit. But while you're alive, your deposit is what tells how much you can borrow. That's where the cash value is coming from, your deposit. Did that help everybody out there?
So the only way I can get borrow against my death benefit or get the death benefit is to die, and then I don't even get it, right?
You have to deposit money.
Okay. So then Justin is saying, hey, Justin, if you take a HELOC out for an investment between the interest from the HELOC and the interest, the policy charges, how would you calculate that with a deal, since you have to factor in your compounding interest the insurance company gives you back with your premiums?
So you have to separate it. So when you're doing the HELOC, you're taking the HELOC, putting it into the policy. So now when you're paying the interest on the policy, that comes off the net from the interest that comes back into the HELOC that you have to recalculate because of the velocity.
Okay.
I work with Justin.
I know. Justin's great. He's here for all your shows, Chris and Steven.
Yeah, I know. I see him every day, almost every day.
And then Jason saying, I'd love for one of you guys to look over my policy. And then where would one go to start that living trust?
Corporate capital would be a really good choice for the living trust. But you got to, before you talk to anybody about the trust, think through, if you were gone tomorrow, how would you want your estate? How would you want your money and your things and your cars handled? Who would you want them to go to? What restrictions would you want to put on them? Would you want to give them to your 18-year-old? Would you want them to get all the assets, or would you want it to go into a trust account where they would have to literally almost do like a loan proposal when they want to take money from the trust, and then have to pay the trust back? I mean, I always suggest everybody reads What Would the Rockefellers Do? We licensed the book. We'll have it out there soon. But if you understand how the Rockefellers built and maintained their wealth generation after generation, that would be a good starting place. But I think a lot of people are just like, they want to buy the widget, but they don't know what the widget does. You need to understand how you want your material belongings, your assets handled if you're not here. Like almost like Garrett Gunderson calls it a, your family constitution.
We'll keep it rolling. Knights of Israel is saying, do you have an IBC 101 video going into all the basic details that you recommend?
Yeah. So, the 90-minute video, 100%.
Okay, we'll link that in the chat.
Yeah, we'll put that in the chat for you.
Yeah,
If someone can find that for me, that would be great.
and don't forget about Take Back Tuesdays every Tuesday.
Yep, and to Thursday, tomorrow, Knights of Israel, we're doing section 2 of boot camp, IBC boot camp. So we're doing 9 weeks of super simple training over on the Founding Fathers webinar. So you can come see us there too, putting those up week by week too on YouTube. So lots of places you can learn from us.
Okay, and I actually have it in my notes, so I'm going to put the new 90-minute in the chat.
I'll put it in the private if you can move it over because I don't have.
That's all right. Bo Knows is saying, I'm 57, married with no kids. Would a whole life policy be worthwhile?
Depends on what you want to accomplish with it, to be honest. Depends on what you want to accomplish. So, I mean, that's something we can obviously work with you on. I have people that are clients that don't have kids, aren't married, that kind of stuff, are doing policies because it fits their
married. He is?
No kids.
Yeah, I mean, in that case, yeah, it would make sense.
Yeah. Sometimes the only thing that people run into is if they're not married and they don't have any kids and they don't really know who they want the beneficiary to be. That's like really the only hang up, but obviously.
Yeah, that's not even a hang up. We just designate their estate to be the beneficiary. I mean, it's not really ideal, but if there's nobody else, we can move forward with that. And then maybe in the future, they have a business partner or somebody.
Or they train it.
We got one coming in from Instagram that I'd be remiss not to talk about.
Sure.
Justin Terragano said, get an IUL. There you have it. The wizard has spoken. Get yourself an IUL. There we go. We can wrap this show.
All right, let's go ahead and wrap this show up.
Yep, wrap up. Like, wow, what great advice.
All right.
What do you think about that, Joe?
We're going through rapid fire. Not that it's really rapid fire. We just have a lot of. All right. Kurt is saying, if I have debt, why wouldn't I pay off debt, HELOC, or real estate loans versus putting cash back into the policy just to turn around and borrow it to pay off the debt?
Opportunity cost, future value of the money. I mean, there's so many reasons why it would make sense to use the policy first. But
Joe, this sounds a little bit like you.
I'm just wondering too if, and I could be totally off base, I wonder if Kurt is missing the point of when you put the money in the policy, it compounds and grows regardless of whether you use it or not. So the reason you would want to do that is so that it compounds and grows for the rest of your life while you use it to go pay that debt off.
So Kurt just needs to get on a call with us because Kurt's got great questions and he's right there. He's just missing some key fundamentals.
Yeah, and it's in the chat, but if anybody wants to get on our calendar, you go to mentors.beyourownbanker.com, and that's going to be our calendar. You just pick a time and day that works for you and put it to your time zone.
Have the wizard.
Call the wizard. Okay, so Christian saying, my fiance just made me cringe. She just told me that two out of three of our kids have whole life policies, but it's not what you teach. As Chris says, her broke brother-in-law sold it to her. How do you guys?
Hold on.
That's
I got some really good news. Like, that's awesome. That's freaking awesome. I know they're not designed the way we do it, but you have policies, whole life policies on your kids, regardless of whether or not they're high early cash value, like the ones designed. Those policies will turn out to be absolutely phenomenal. Watch I got several YouTube videos showing my old New York life policies, which are policies that my broke-ass brother-in-law would sell me because they're normal off-the-shelf whole life policies. But they're old. They're like 15 years old, and they crush it. Your kids' whole life policies don't need any changes. They don't need to be replaced. They don't need to have anything done to them except for time. Just let them grow.
Yes.
Cool. Living the Life said, Joe, should I make the deposit into policy through my HELOC?
If the HELOC is your one-pot system and all the money is in the HELOC, where's the money going to come from? Yes.
And then Alyssa is saying, on a $10,000 a year premium, is there a limit how much extra PUA one can add? Should I get a large one amount 1 year?
Yes, there's definitely a limit. What that limit is, we could find out for you from the insurance company if this is a policy you already have. Potentially, you could even go directly to the insurance company. What I would suggest is get in contact with your implementation specialist, and he can help you figure that out, he or she.
But I mean, simple math. If you had a $10,000 a year policy that you designed and it was built, the max you could probably put in is close to 100 grand, about 10 times.
If it was built,
the policy is not already in force.
Okay. And then Jason Roundtree saying, I'm able to take a $2,000 loan against my death benefit. It must be cash value. Would I be able to benefit from PMC with that amount, or do I need more?
Yeah, I mean, it'd be tough. I mean, maybe notes, like talking to Kevin Shortell, you might be able to get into some notes with that. You wouldn't be able to take down any kind of private lending deal, maybe come in on a private lending deal, but I think you're probably looking at like partials and things like that. But there's definitely a place you could get that to work. But if you've got, but if you've got debt, please use it to pay off debt before you start lending or doing anything like that.
I'll also say some maybe off the cuff, like an off the record advice though, is that there are some people who do want to open the door to private lending and that type of thing to other people. And so it is worth saying in the forum, maybe like just where you're at, and maybe you can help somebody with the closing costs and get like, I don't know, $200 on that or something like that. Because I heard someone on our team, not someone on our team, but someone in PMC talking about doing that for somebody who didn't have a lot of money because they just wanted to help them move. You know, $1,500 was the amount, and I know that person's not going to get much out of that, but still, just the fact that you're doing that is really cool, and it sets that tone for the rest of your life. Andrew 10 is saying, hi, can you take a loan from your 401k to fund a whole life policy, then take a loan from the policy to pay off an installment loan?
Sure, as long as the cash flow makes sense to you. It better run those numbers.
Well, the 401k, you're going to pay yourself back with interest.
Mm-hmm. Yep. That's actually a form of being your own bank right there.
I don't know. I mean, you probably have to have Craig run the numbers. I would think that to take a loan from a 401k just to run it into the whole life, to just then pay off an installment loan is just extra work. I'd almost say, and I don't know the specifics, but I'd almost say just go the loan from the 401k, pay off the installment loan, take the payments that you were making on the installment loan, put them back into the 401k and be done with that, and use the policy, you know, for other things than that. I just think you're adding an extra step that really probably isn't going to give you a huge financial benefit until much later in your life. And I'm just being honest.
Well, the other step that he could add there is if he'd used the 401k to pay the debts off, paid the 401k back, and then that payment that he was paying to the debts, that's now free to do something else with. That might be the time.
I love that.
Funds the bolus.
I just think sometimes we just go too far with like what putting dump-ins in, and I hate it. Like, I hate taking money from 401ks and dumping it into the policy to then pay off loans. Just do it direct from the 401k.
What happens if that installment loan is like $500 and he runs $800 through the policy, and then he takes out the $500 to pay that installment loan? So he's only building the policy just to pay that installment loan with the amount of money that would come out in cash value. So now he's actually paying himself before he pays that installment loan, never losing that money. And then once the installment loan is done, he just puts it back to the policy.
I'll say one thing. That maybe would be a discussion I'd be willing to entertain if there was a very strong need for the death benefit, for the life insurance protection for the family. Otherwise, I would still say don't. I would not write that policy for somebody if that was what they were trying to do. I just wouldn't. There are compliance issues. There are all sorts of the insurance companies would definitely not like that. But if the death benefit need was there and we could substantiate that the death benefit was important for that client, 100% game on.
Cool. I want to bring it back to Christian with the kids' policies from the broke brother-in-law, saying, should I change her whole life policy that her broke brother-in-law sold her? I think you mentioned leave the kid one sit and be.
No, there'd be no I mean, it'll still, even just a regular old off-the-shelf whole life, as Chris was calling it, it's going to perform really well because it's going all towards the base. And over time, once you hit that efficiency point, it's just better and better and better. It just doesn't have the same kind of ability to have more cash early on, but it does have cash value eventually. So no, I would not start over.
Okay. Auto Fee says, how does tips from a job affect the amount you can put into a policy, whether it's base or paid up additions?
It's a moot point. It could go into base, it could go into additions. I mean, tips are going to be counted as income from the insurance company standpoint.
Qualifies you for more and all.
Yeah, so I think what they're after is, or the way we would look at this is your tips, your wages, anything you're earning, that's all income, and income and your age with a multiplier drives how much death benefit they'll allow you to have. So it's your human life value is going to be based on your age and your income. So those tips are going to make your human life value go up, which means your death benefit goes up, which means you can put more money into the policy.
Share Chris's win, Christopher.
Yeah, first I want to say, found Chris Nagel's videos back in January and studied nonstop a few months to grasp it all. Thank you so much. He's saying, hey, everybody, I started my IBC policy at $1,500 a month this year in April. And after 8 months, I've contributed $14,500 and paid down $10,000 so far. No credit card debt, and only have $15,000 left in personal loans.
That's freaking
Awesome.
Congratulations.
I wish I heard that every single day. I really do.
Yeah, their wins are there. Their wins are there.
Congrats.
So thanks for sharing, Christopher.
We are from you. And then Nathan Buzzle. Hey, Nathan, we saw you at Money Tank too. If I get a HELOC and I already have a policy, can I dump that into the policy, or do I need to start a new policy?
No. Why would you want to take it out of the HELOC and put it into the policy?
Yeah, we're missing the other part of it. Like, why would you do that?
There must be more.
There's got to be an extra step.
Well,
you're paying more in interest to the HELOC with opportunity costs. The policy is an asset from day one. So if you're worried about, I don't know where we're going there.
Yes.
If he's talking about whether he can fit, a chunk of money into his existing policy, or whether he needs to start a new policy, if it's just about that piece of the conversation, that's again something that implementation specialists can help you with. See how much room there is in your existing policy, if I'm interpreting that correctly.
Yeah, and I don't want to speak for Nathan, but he was just at Charlotte, and so I'm sure he has a place that he's looking to put that money from, one of those PMC connections. So I'm sure it has a use from there.
Yeah, I think maybe the question is just not deep enough for us to really kind of answer that.
Yeah.
Or it might be a new one.
That's true.
Maybe? I don't know.
Also, velocity banking can come into play, all that stuff.
And then I don't know that you can put a large dump into an existing policy if you didn't build it that way.
You typically can't. Like in the first year, you might be able to go back and get re-underwritten to hold that, but very strong probability of that not happening.
Yeah, I mean, the most common question we ask, right, is it's an 8-ounce glass. Can you put 12 ounces of water into it? When the answer is no, then you go build additional warehouses of wealth. That's kind of what we're talking about. So
there is a depends on that though, because I just recently went through this with a couple clients where they wanted to put more in, similar to what they did in their first year dump in. So we went back to underwriting, asked to get the approval for it. Some companies will do this, some won't. But in this particular case, the company said, yes, you're good to go. So he's able to put his dump in years 2 and 3 and 4 or 5, 6, 7. But that does require knowing what company you're with.
Yeah.
And you also have to meet those underwriting requirements. So if your death benefit numbers start going above what's called your human life value, then that wouldn't be approved. So the message there would be talk to your money mentor and see if that's an opportunity for you, or talk to your implementation specialist and see if that might be something they can do for you.
And we got one last question here. Is Alyssa saying, which is your favorite insurance for legacy minded? Is it the Beast 75-25 split or Nelson Nash? And how much does the premium or base become after year 10?
For a legacy minded, like death benefit, the Nelson Nash.
I spent an hour and a half today going over with somebody. We were talking about the 70-30 versus 60-40. His was also for legacy. There's a lot of considerations, right? He was like, well, year 20 will be 80. And so we want there to be less that is due in the premium deposit, even if we can't put as much in as we would have been able to with a 60-40 split. So there's a lot of considerations to talk through if we're thinking long-term. And we went back and forth a long time with this guy today, showing him all the different scenarios. So,
And I think the last part of the question there is, what is the base after year 10? Well, the base is always the base, right?
Yeah.
So if you have a $10,000 premium on a 75/25, your base is 25% of that 10,000, 2,500. If you have a $10,000 premium and you're doing 60/40, then 40% is your base, which is 4,000. So that's really going to depend on those splits. But the base will be the base. The base doesn't change. That number is going to be the same. So on a 60/40, 10,000 premium, it's 4,000. On a 10,000 premium, 75/25, it's 2,500. And to Jason's point, if you got to the point where you're only paying base, 2,500 is easier to do than 4,000. So that might be, fit into your legacy plan.
All right, then I do got two questions that came in real fast at the wire. So DJ Scott saying, I remember a few videos ago, you guys did a paper on term and invest the difference and disproving it. Who would I get a contact? Oh, yep. And then Linus, you put Craig's email in there. So Craig@chrisnoggle.com, and you can get that white paper. And then Jason is saying, I've been paying a mortgage since 2021. How can I find out about how much equity is in my house? I got it for 405.
Get an appraisal.
Yeah. Call up an agent and get an appraisal.
Or a BPO. Yeah.
Appraiser.
All right, we did it.
That was all of them?
I think so.
That's also the hour.
Boom. Yeah. Brandon just said Zillow right now is running at about, within a $20,000 range. So if you want to know what your house could be worth, go into Zillow, put your address in, and give or take 20 grand.
Every time I do that, I'm like, I'm out. Peace. And I'm like, wait a minute.
Yeah. Yeah. Well, sometimes it's a little far from reality.
I'm like, oh, I should probably just call Joe and get set up. But one of these days.
All right, folks. Well, these are a lot of great questions, just great questions, especially, I love our commentator up there on Instagram. Just literally, we could have saved yourself an hour. Just get yourself an IUL. But with that being said, folks, thanks for joining us. We'll see you on the next webinar, which will be tomorrow. Join us tomorrow for, what's the name of tomorrow's? Quick Start, which is an amazing webinar put on by Noah. We'll see you then.